So IAS 20, the government grants, they are essentially to address all sort of support any company, enterprise, small or large businesses get from government. And this one is interestingly quite relevant for modern time, because we hear that governments are trying to inject the cash in the economy, definitely because of the slowdown and the corona impact, etc. So government is not only just making interest rate lower so that more people can borrow, they're also directly supporting the businesses, and that is happening across the world. When the government support the business, it can have dozens of different way. So here we are not talking about any way they encourage the bank or they give a tax relief. In fact, we are talking about the direct benefit support to the businesses to flourish and even survive. When it comes to the government grants, government provides that in various in various forms. Some becomes like a balance sheet item, which is kind of asset. They can provide the asset or finance the buying of assets, or they can also give some revenue or support, which is more like an income. So in both ways, governments can support. So government grants, as we discussed, is assistance by government in the form of transfer of resources to an entity, and it could be in return of past or future compliance with certain conditions. So for example, suppose that someone starts to kind of you might hear often that so many times the foreign governments say that, okay, we are going to give you the citizenship or the green card or the visa, etc., if you, or even they can provide some additional benefits, some dollar based incentive as well to business, if you commit to provide 10 employment in the economy, or you commit to serve a particular sector. For example, weaker or maybe elderly or any particular kind of sector you decide to serve, government will provide the incentive. So that is kind of a compliance based incentive where you have to fulfill the criteria and compliance, and government will provide you the support. Now this exclude the forms where you cannot quantify the benefit. So for example, the government grants, as per the accounting standard, can only deal with a quantifiable or a measurable benefits, right? And this is an underlying and overarching concept in entire accounting world, or more particularly in IFRS, that if you cannot quantify something or you cannot measure, you cannot put in the primary statement, right? And it doesn't mean that it is not true. You might still be getting some assistance, some benefit from the government, but if you cannot really put a number on this, if you cannot quantify this, then there is no way it can appear in the financial statement. So the quantifiability is important.
So how we can quantify it? Let's suppose if government is saying we can provide the feasibility of the stabilizing the business. We can give something like uh, we can help out for the land, providing the land for the set up the business. So set up the business, they can provide, like, instead of four document, the businessman can provide it to one or two, and they can provide the land likewise.
Yeah, similar to that. Let me make the scenario more specific. Say you decide to open a small medical shop, or sorry, let's say a school, okay, in the area when there was no school. Government wanted to support such edupreneurs. So what can happen? You might not have that much capital. Government will say that, okay, fine, what I will do, I will provide you 1 acre land, and you need to kind of put a ceiling on the fees, and also 50% of the seats in your school will be reserved for socially weak people. Okay. So do you see the grant here?
Yes.
Government's grant?
Yeah.
Okay. Do you see that it can be quantified?
Yeah.
Because the amount of the the land which is provided, or maybe it will be on a lease for say 30-40 years. So you can quantify how much benefit the government has given in terms of the market value. So anything that government does, whether it is in terms of dollar or any support, you can quantify for the fair market value. If you are going to get the same or similar support in the market, how much will be the value? And that's why quite often, whenever there is a very specific benefit government is giving, you can always quantify and accordingly reflect on the primary statements.
Okay. So before the I have a question related to the definition only.
Hmm.
I'm taking the same example. So if I go to the prepare the balance sheet on P&L for the particular industries or for the particular school,
Hmm.
right? So in that case, we are not consider the land cost in the anywhere in the financial report, because that land is provided by the government free of cost. I'm talking about the accounting entry and treatment in
Got it.
the.
Got it. Yeah. So here you can consider this like a income item whereby government has given you either some discount in expenses. So you can have a line item in the P&L saying that admin expenses or the rental expenses. Okay.
Yeah. Yeah.
And you can either have debit and credit both there, just to reflect that government has given you that benefit. Okay.
Okay.
Or it can also happen some situation that you have tried to buy the land and government has given you some cash, or government has given you the financial support to buy that. You will have some situation like this. So if something you bought, the land you bought for 100 million, and government has given you 40 million to support that. Okay.
Okay.
Then you can treat that 40 million as a deferred income. Okay. Why deferred income? Because this is kind of a liability which will be extinguished over the period of the business gradually. You need to depreciate that. So the reason is you have already spent 100 million. You need to have the proper accounting anyway for the asset. The land that you have bought or the space that you have bought is still 100 million, even if government has supported you. But government has financed 40 million out of that. So 40 million is your liability. Even though government is not going to ask you back, but still it is a liability for the purpose of accounting. And then you need to amortize that gradually in the books. Okay. And when you amortize in the book, what will happen? That will become a credit and it
Yeah.
will reflect like an income in the P&L. Okay. Because when you have a liability, you reduce that every year. Then you need to make a debit entry into the liability and credit entry into the P&L. So ultimately, even that government support becomes a credit entry into the P&L, and it will start to reflect like a income overall on the primary statements. So that is one way. So there are various ways to reflect this. Typically, we try to reflect this as a direct reduction. When the government supports something, we just reflect that as a direct reduction in the cost, or we create a liability like a deferred income, and we try to amortize that over the period. So there are 2-3 different ways, and we'll have some numerical example as well to reflect how the grants are treated in the P&L or the balance sheet. Objective, we have talked about disclosure and treatment of government grants. Now, government assistance takes various form, both in the nature of the assistance given and in the condition. Okay, so there are two ways the primary statement can reflect it, as we discussed. If resources have been transferred, then appropriate method of accounting for transfer must be found, or and it is desirable to give an indication of extent the entity has benefited from such assistance during the reporting period. So that the second point is really the, again, quantification, like what is the extent of the or degree of the benefit that the company has gotten. So you need to quantify the benefit and extent of the benefit, and then find out the right way to reflect that on the primary statement. So whether you need to reduce the price directly, because in the previous example, right, when I talked about the deferred income, there's another way. You just reduce the price of the land rather than reflecting 100 million worth of land and also recognizing a liability of 40 million. You can just also reflect as a 60 million, but that's not as preferred method because it's not reflecting the economic substance accurately. But there are 2-3 different ways, and situation to situation it can vary. If the government is say supporting you in R&D, research and development, or government has made a condition that if you do the R&D in a particular area and it is successful, they will refund you. So there could be various situation, and accordingly that entire treatment is done. So quantify the benefit and then look for the appropriate method how to recognize this. So that's the objective of IAS 20. What is the scope? So we have talked about recent today itself, IAS 41. That is not part of this. Anything that is owned, so government also invest in various entity, PSU and semi-government organizations like IDBI. Government makes some investment like 49 or 50%. So government investment as such is not part of this because it's not a grant, it is an investment, it is the ownership. And finally, if a government is trying to provide any tax exemptions, any tax benefit for the purpose of calculating income or tax liability, that is not part of this standard because that is more sort of tax code and tax related matter. And I believe there are some other sections like of IAS 39, IFRS 9, whereby the government's investment is through the financial instruments. Those will also be outside the scope of IAS 20. Grant relating to asset may be presented in one of two ways. Okay, what are they? The deferred income. By now we know this is a familiar term. And release to profit or loss when related expenditure impacts profit or loss. Okay, so let's absorb this one. So when we create a deferred income, what is that? Liability. So taking our example further, 100 million worth of assets and 40 million worth of deferred income was created because government had provided us some cash. Okay. Now, with say that that lease is only valid for 10 years, we need to kind of amortize that benefit. So what it is trying here to do, for that asset or the benefit or grant the government has given, you will be in the business, right? And you will be getting some income as well with in relation to those asset or the grant the government has provided. So because that will create some asset. If you have an asset, you will utilize that future economic benefit and you will get some income. So it's trying to say that every year when you are in the business and there are some expenditure for the business, then you need to release the the deferred income into the P&L. Releasing the deferred income here means amortize that liability into the P&L. So if you amortize that liability into the P&L, it will become a positive number, or I should say a credit entry, which is an income. Okay, so you can still reflect that in the expense section, but as a credit entry. Or some auditors are particular about this, not to have any credit entry into the expense section. So then you can move into the what do you call the income part, revenue section, just to have a different format of disclosure. It's just a matter of preference, because IFRS, you know, that does not prescribe a fixed format for presentation of financial statement. Are you aware of this, right? So you can release the deferred income every year as the business continues, like amortization is done, and that will reflect the benefit given by the government. Second part is deducting the grant from the assets carrying amount. So that is a simple one, and we discussed briefly that you just reduce the cost or the carrying amount of that asset. So if you bought the land for 100 million, 40 million was support from government, so just record 60 million as a cost of the value of the land. Then you don't have to make any further entry or adjustments. Of course, not to forget, the disclosure notes will have all the details, how much government had provided and what was the total worth, and how much discount was applicable, etc. Those details will go into the disclosure note, but on the face of the primary statement, you don't have to disclose anything else if you decide to deduct the grant from the assets carrying amount. Are we good so far?
Yeah.
Grants related to income. Okay, so there could be some grant in the income section as well. So non-monetary ones, such as land or other resources, so they are valued at fair value, and they actually reduce your rental or make the rental zero. So that is a grant relating to income. And how do we reflect that? So either you can have other income in the revenue section on the top of the revenue. When all the incomes are added, you can just have other income. Maybe in the bracket you can say government grant, because it is important to categorize separately. And this other way, you can deduct it from the related expenses. Okay, so suppose that you have expense and government has provided you some land or support, so try to directly reduce that expense from the admin expenditure, etc., because that will just reflect that your expenses are lower because government has provided a support in reducing that particular item. So for example, government has given you the space or for the school, okay, or maybe government has given 50% discount into that. So you just record 50% discount onto the face of the P&L and provide the disclosure that what is the arrangements. So deduct the related expense in the P&L. So in that case, it will not be in the income, it will be in the expense category. Now the next one is grant receivable or as compensation for the cost. Okay, so what it could be? What would be a grant receivable for the compensation for cost? Any thought, suggestion?
Nidhish, it can be either, like it can be a land or anything, like, because a grant receivable as a compensation for cost.
Yeah, correct. But as a compensation for cost, it would be more relatable item. For example, imagine the government is supporting, you would have seen the news recently, the central government is trying to make India the AI power. Okay, if you decide to do some R&D in AI or robotics, government can provide you some compensation for that. So you incur, say, a cost of 1 crore already, and government will compensate 50% of that. So how it will be done is, you have expense month on month either, and government will reduce that expenses in your P&L, or if you have already spent that much and government has given you that refund, then it will be like a income item. But the difference will be, it is not a kind of land, because when government is giving you the land, it is not for any action that you have already taken, right?
Yeah.
Yeah.
In that case, it is a pure favor, if you think. But when it comes to as a compensation for cost, it seems more kind of a, you have earned it. You did you went into a venture which relates to society, the economy, or the government's own mission, and since you did that, government is trying to compensate you for being aligned with the government's or the country's objective, and hence, in a way, you have earned it. So those kind of grants. Second is the immediate financial support with no future related cost. So it could be just no future no future condition relates to this. It's just that you have started a business and you are facing a problem. You want to do the research in robotics for defense. Government will give the immediate compensation that, okay, you can continue to operate and do the research, and we will finance your research, maybe 50%, 75%, or 100%. So that is purely on the condition that you incur the cost and we will finance your cost.
So Nidhish, we can correlate with this this also, like the recently government has given the offer to the all the customer for home loan, like in the COVID situation, the 3 month no one can if no one can bounded to pay the home loan to the bank.
Moratorium.
Yeah, moratorium. That, so we can correlate that thing for the, if you're talking about a individual basis, like I got the government grant for that in the COVID situation, we are not able, we are not bounding for the payment of the home loan for 3 months.
So I think your angle is as an individual, right?
Yeah, individual only.
Yeah. So this is more for the business, not for the individual.
Okay, so the second example is that like in the app number the Making India process just now started by the government of India, right? So as per the government of India, if someone want to introduce your product, so they can help out for the promoting and all. So
that's yeah, specifically and very relevant one, because Skill India, Making India
correct.
movement,
Yeah, yeah, correct.
So if you start, say, manufacturing of PPE, very likely you apply to the government, and government will almost either will give you the land or will finance 50% of your cost, saying that, okay, if you don't have enough money, we can support you, right? But government will also ask you to reduce the price. So this kind of arrangements can be easily done, and government do that. In that case, you have a very clear grants related to income, and that relates to the cost. So government will compensate your cost, and it will be a grant related to income, because it is ongoing. It's not once off. Yeah. So yeah, normally every government has some schemes, and they support their businesses for various reasons. Some of the reasons are that they have a budget to pursue their own missions, and they will finance if you are one of the businessmen who are aligned to the national goals. So whatever the refund that you get, that is a grant related to income. Recognition of grants. How do we recognize? So basically, there are some conditions attached to the grants. Okay. So one is the grant, the entity will comply with the conditions, and then only the grant will be received. So before we take any step to recognize the grant, we need to be sure, that that the business that we are into and the government's conditions are going to be met in the future. Okay, so the objective should be that, okay, if you think the government can even ask the grant, or the bank can even ask the grant back if you do not complete the project, right? So there one need to be more careful that project is either making right progress, or if there is any doubt that project might not be completed, then do not recognize the grant. Keep that as a liability, whatever the grant that you get, because there could be a chance that that you have to refund the grant to the government if the project is not completed in the manner it was asked for or on time. And if there is any possibility, a substantial possibility, that the project will not be completed as expected and government can seek the refund based on the clause and of the agreement, then it's better not to recognize the grant. Of course, once you have completed the project and then all the terms and conditions are met, then you can recognize the entire grant.
Nidhish, one quick question. Like say for the grant, sometime we is it like a grant would be like received in the cash or something, or is it like a deduction? Like I just say the electricity government provides something like if I'm starting any government project or any SEZ, Jones, if I create something, then usually the per unit would be the 6, but if I grant getting access from the government, then it will be a 3. So is it like can be any form?
Yeah, it can be any form.
Okay.
That's why it could be dozens of different forms. So happy that you added that example of SEZ. I was going to talk about that. So often if you want to set, say there's a in Gujarat there's a gift city, and government has already declared to many multinational companies that if you come there, we'll give you maybe 50% relief in tax and etc., right? Or the land, free land, electricity, water, etc., right? All these grants are subject to IAS 20. A. B. You can quantify them as well, right? And I would see that except for the land, which is given for free for some time, multiple or most of these grants are related to income statement, because as you said, electricity is free, right? So you need to still show the electricity charges expected maybe, or then show an income from government. You need to still recognize the income and expense both for the better clarity of the users. Because if the electricity bill is waived or water bill is waived, then all these can be quantified and should be reflected in the income statement. Right? Okay, so the disclosure part, accounting policy should be first reflected how the government grant is going to be reflected in the financial statement. What method are you going to choose? Because we have talked about the methodology. In the balance sheet, you can reflect it as a deferred income, or you can deduct the overall deduction of the overall carrying value, or you can choose to reflect that in the income statement. How you want to reflect, where you want to reflect, how do you want to calculate that, what is your estimation of the government grant, right? Because accounting policy and the estimation, both which is governed by IAS 8, is required here. So you need to decide what is your estimation, what is the useful economic life of that benefit that government has given, how long government is going to give the benefits, how are you going to quantify this. All the details should be explicitly mentioned as part of the disclosure notes of financial statement. Next, nature and extent of grants. So yeah, I think we have talked this one, that what is the nature, what is the detail, what grant is given, what is the terms and conditions, what is the clawbacks. You know, if you do not fulfill the project requirements, terms and conditions, qualitative and quantitative criteria, then what can happen? Can government recoup all of them? So any other forms of government assistance. So anyway, if we are providing all the details, that will be covered. And fourth point we have also covered: unfulfilled condition and contingency. So what are the terms and condition, and what can happen if you don't complete that? So this should be all part of the disclosure. Now, at this stage, you would start to get the feel, that what are the disclosure requirement for any such standard. You just need to talk about key numbers. You need to talk about the key terms and conditions. You need to talk about key variables and any such detail which the users would like to know, or it can impact the decision of the users. So these 3-4 types of things must be in any disclosure, regardless of the standard that we are following. Overall, the principle of IFRS require that you need to have this qualitative information. It should be current as well. It should be relevant as well. This should be, and if needed, it should be prudent. When it is matter of liability, you need to kind of show what is the higher side of it. When it comes to asset, you need to take the lower side of it. So those kind of expectation is there for any type of disclosures. Self-test question. There are few now. So there are two methods which could be used to account for government grants: capital and income. Okay. So can we maybe take you all are three only, can you just provide your rationale that why capital approach is good, and then someone can provide the argument why income approach is good, why income reflects the economic reality better of the grants, because both approach can be used and both approach can be applicable. So there are two approaches. Why capital approach is superior in some case, and why income approach could be. If you have to write a short note, what will be those?
So, Nidhish, in the income approach, the grant is recognized the P&L over one more period. So, if you got if you got any grants, then like you have given an example for the 10-year of the leased, and what maybe the grant we need to be amortized during the periods, like for the 10 years. And yeah, so your question is like, which is the good one, right? Or it can be both of them.
No, my question is this: suppose that you have to advocate for that capital approach is a good approach to recognize the grant. Okay, what kind of argument and support will you provide to back up your side? If you have to say advocate for capital approach, that okay, the grant should be used, reflected through the capital approach, or you might choose income approach, what will be your argument to support? Because see, we can reflect the grants in two different options, two different way, right? Everyone has a preference, everyone has a choice, and they try to go by one choice, one preference. Of course, there are other accounting rationale, but if you have to support that okay, capital approach is good one, what will you say in the favor of capital approach?
So, Nidhish, as per my understanding, I will go with the capital approach, because if we go with the capital approach, this is the simple way we can uh, that capital approach means directly impacted on the balance sheet portions, balance sheet positions, and this such means grant will be impacted to the total investment of the business. So if we go by the capital approach, definitely we will show we can improve the balance sheet of the company as a healthy investment. We can show the investment point of view, and we can attract to the other investor as well. For uh, if we have the good or healthy balance sheet of the entity, right? So this is my approach, and because if I go with the income approach, definitely we need to impact the PNL and PNL, and that will impact to the daily ordinary business activities on the for the particular period, right? So I will not go with the impact in the business activity for the particular period, because it will be if it is the impact government grant impacting in the our balance sheet, so it will be go and it will go for the long run, the or run of the business.
But then the question is that which one sounds like closer to the economic reality? Which reflects the economic reality better? The
Yeah.
capital approach or income approach? It's one thing that it will reflect the balance sheet better, or it will attract more investors. That's one perspective. But the from the accounting perspective, we should be more relate to what is the right approach to reflect your economic reality or the financial position. What is better from the accounting perspective? Because from the finance perspective, it could be better that we reflect in the capital approach, because the balance sheet will look stronger and will be healthier and investor friendly. But from the accounting perspective, what is better? What reflects economic transactions better?
It can be, Nidhish, for the income approach also, like we are as per the accounting principles, what all the expense and the income related for that period we are booking there.
Because ultimately, if you see, government is not an investor into this. So some argument goes like this: the government is not the investor. So why to reflect that in the capital approach? And the second argument, which is again favoring income approach, is that government has provided any grant for your day-to-day operations for your ongoing business. Hence, it is supporting your ongoing profit and the P&L and the operations. So it is matter of operations. It should be reflected in the operations. So there are arguments for both of the approaches. Many favors, actually more people favor income approach. And these are some of the arguments. Government's grant are a financing device and should be dealt with as such in the statement of financial position. So while government is giving the support on day-to-day basis, then some argue that, okay, it is not really earning. So why to reflect in the P&L? But while it is not an earning, it can still reduce the expenses. Overall, it is up to the government also to kind of keep the expenses in control and in the check. So if the government is reducing the expense of your business, it could be appropriate. But the capital approach says that, okay, it should not be reflected there in the P&L. So income approach, yeah, that takes the view that it is not an investment. Government is not the investors. So why to reflect that there? And since it is attached to the government objective, the mission, and the government own goals, government is trying to reward us or trying to compensate us for following those objectives, then it should be recognized as income in the profit and loss, right? So why this is beneficial to have both views? Because this will clarify that in what situation we should take a particular approach. Because if you see that government has given a terms and condition attached to any particular approach, to any particular grant, in that case, it should be treated like a income, because you are fulfilling the requirement and you are earning the grant. Right. So here is a situation that we talked at the very start of the session. So there was a equipment purchase for $100,000 and received a grant of $20,000 on the cost of asset. Now we are making the entry into the balance sheet. So the capital approach is taken, balance sheet approach is taken. What should be the accounting entry? What is the common consensus? How we should do this?
$20,000 should be recorded as liability, and 4,000 per year should be credit side.
Credit side. Okay. So look like we are on the right target without even writing. So what you're saying essentially is the first year itself, we make an entry of $100,000, debit asset by 100,000, right? Credit cash
Yeah.
by 80,000, credit deferred income by 20,000. Agree?
Yes.
Then on the same year, you need to also reflect. Sorry, my throat is very bad. So a depreciation of the 5 years. So 20 by 5, 4,000 is the depreciation, right? So that depreciation will be also accounted for here. So credit, debit the deferred income liability in the balance sheet, right?
So what is the debit?
Debit the deferred income
Okay.
liability
Yeah.
for the first year. Let me just write it down. Give me 5 seconds.
So first year deferred income would be 16,000, right, Nidhish, and 4,000 will go to P&L
Yeah.
at the end of first year.
I think because we need to be recognized 4,000 for that year.
You see this? So the first entry to start with, debit this and crediting what? 80K. This is the cash that we are in reality we have spent. Okay, this is the real cash from your cash account. Crediting, and then credit again 20K.
The government grant.
Yeah. So this is deferred income.
Yeah, deferred. Okay. Fine.
This is done. Now another entry, same year. So this is, let's say, year 1. Same year 1, another entry. So we know that 20,000 is the deferred incomes by 4. No, so by 5 is 4,000. That should be that should reduce our liability, in fact, right? So the liability is what? Deferred income. So credit. Sorry.
It should be debit 4,000 and credit 16. And
yeah, so the debit the deferred income, def income by 4K, and this time credit the income statement. So let's give a good word for this. Def income recognized. Okay, that's 4K. Now this will make your final position of deferred income in the book, year 1, balance sheet, def income, a liability is only 16K. And you have in P&L income also recognized as 4K, right? So this should be the entire scenario for this. Any question on this?
Nidhish, one thing only. In the first entry, the deferred income, what you have mentioned, that is actually the liability part, right? That is the liability only, right? We are.
Let me write down. Yeah, because we are crediting. So debit, and it is a balance sheet entry. Okay, so this entire is a balance sheet entry.
Because the naming convention is deferred income, so I was just thinking, but it's a liability side only, the credit 20.
It is liability. Yeah, it is liability.
Okay.
So balance sheet, debit the cash. Sorry, debit the asset, then credit the cash by 80K, and then recognize the liability. So the balancing number is your liability, which is deferred income. So this is all the balance sheet entry. Then here you start second entry, and this is the summary of everything for first year. Any other question? And this would be one of the very frequent way if you recognize that in the balance sheet, then have the entire asset, and it is kind of a relatively more complex one. The simple one is just to reduce. If we were not taking the deferred income approach, we could have just recognized this money, actually this asset. So have a debit of how much? 80K. What is this? Assets. Then credit of 80K from cash. So your balance sheet is done. So this would be approach in case you are just taking the view of directly reducing the price. Then it is very simple. This is small box, that's it. Nothing else to be done. Are we good? This is really like essence of the IAS 20. The same thing that we have talked about. Then accounting for grants related to asset. So read this through and we'll go step by step. This will be longer and kind of a couple of page long solution. But before diving into the solution, we will discuss the high level approach, because solution is just breaking down the number and dividing, multiplying, but we need to first understand and sink in what approach should be taken, why we are taking one particular approach or the other. So 20% grant is received for 300 worth of machinery, right? What is that? 60,000.
Yes, sir.
Expected life is 4 years. Okay, if I divide this by 4, let's do some quick math. 15K depreciation. Again, it's not right word, but loosely speaking, it is a kind of depreciation. The expected profit of the company before accounting for depreciation on the new machine on the grant amount to 100,000 per annum in each year of machinery life. Okay. So what is this 100,000 is doing? this is EBITDA of the company. Do you know what is EBITDA?
Yeah, I mean before income tax, depreciation,
Yeah.
amortization.
Yeah, before in interest, tax, depreciation, and amortization.
Yeah.
So 100,000 is that. This is given just to help you calculate the entire P&L on the basis of the grants and how the grants are applicable for the balance sheet as well as the P&L side. So that's why we are introducing some more number which is not directly related to grant, but it will help visualizing the entire balance sheet, P&L, etc. For the grants. Now, double entries for 4 years. What would that be? And 2 income statement and 3 balance sheet. So this is your P&L and balance sheet that you need to also reflect. So how all the entries would be made. So one thing that we can see is we already know income, EBITDA. Okay, let's call EBITDA in a very, again, high level income. So 100K. And what is the depreciation? Not this one. This is only for our grant. The actual depreciation is
3 lakh divided by 4, 75. Yeah.
that is EBIT. Okay. Anything else?
This depreciation, shouldn't this be calculated on 2,40,000 after 20% grant deduction?
No, because the overall depreciation is taking place. We'll factor that grant next step. But the first thing would be that we need to have a very clean way of like reflecting depreciation, rather than having 300 minus 60,000, 240, and then depreciate that one and then another one. It's better that we just depreciate the entire amount, because machinery is going to depreciate and at that level. So at 300,000, we will factor the expected profit and the what do you call the deferred income separately anyway. But this will be kind of a very easy way to understand that, okay, 300,000 worth of asset, 1/4, 75K is depreciated. Because if there was no grant, the asset will also depreciate anyway at this rate in the absence of any grant. Because later on, we will do the accounting for grant. And why we are not trying to adjust the grant into the depreciation? Because the grant is, remember, your income, isn't it? Grant is not depreciation. Grant is your income. You agree? So we cannot mix the government grant and support with the depreciation. We cannot net off, because that's another sin in the world of IFRS. We should never net off two numbers. We should always show them separately. Now let's do the accounting for the grant, deferred income, which is 60K. We need to depreciate that. So that should be 15K. So basically 15K should be recognized as an income. Okay. So grant or deferred income, basically, that will be 15K. Okay, so far. And then we need to have a tabular format for each year to show how it will go, because this 60K is going to reduce year by year. This liability will reduce year by year. It will become 45, then 30, 15, and 0. You agree? In the balance sheet, it will depreciate like that. Plus this 300 worth of asset, that will also go down to 25 first year, end of first year. So let's look at this way. What is our journal entry? Debit the machinery, we know that. Credit the cash, then credit the machinery and debit the cash. Do you agree?
Yep.
So with this first level of journal entry, first year depreciation expense and accumulated depreciation.
Yeah. Yeah.
And any question? So we just need to come to the accounting treatment and one view of the complete balance sheet, etc., and P&L. But do you have any question before this?
Nidhish, again on the second slide, that 2,40,000 we have. If you go to next slide,
Yeah, it's
this particular entry. If you go back for previous slide, this 2,40,000. No, not this one. Previous. Yeah, these are the entries. So here, this 2,40,000, you're calculating after grant, or it should be 75,000.
It is after the grant, so it is 60,000. But the depreciation for the the entire asset should be calculated. That's why it is 60,000 only for the grant amount. See, it is starting from here actually. So this is reflecting the depreciation on the grant amount. So 300 minus 60 and 240 minus 4. So that is the depreciation expense. But that's why I wanted to show you that the final number, how it should look like on this page. See, the depreciation comes back to 75,000 here, because it is the total depreciation that we are reflecting year on year. See here also statement of the financial position. So we can break it down in two parts, but ultimately we will reflect as the sum total. Back to here.
No, Nidhish, the if you go back in the 15 number slide, not 15, 17, I think so. 240 lakh. Yeah, same. I'm talking about the entries only. We agreed that the accumulated depreciation is 75,000 and the grant is 15,000.
Correct.
But if you come into the general entry, so we have to pass the whole depreciation expense and credit the same amount for the 15,000, right? I think that is the confusion here. Like
oh, okay. So if you credit the, all right. So let's see this way. If you credit 15,000 as your income, right?
Yeah.
You also need to debit the respective depreciation for that amount.
Yeah. 75,000.
Exactly. So what is happening is, with 60,000 depreciation on the grant on the non-granted amount, your own amount, and then 15,000 every year's additional depreciation will also take place. So that becomes 75. So this entry is correct to the tune of how much the organization owns. So this is the summary. Okay. Year on year, we have 100,000 minus 60, which is a profit of 60,000, 40,000. Or we should not go to this level yet. Okay, let's take here. So what is your question?
My question is that we are in the double entry. We are passing this. We are using the 60,000 amount rather than the 75,000.
Okay. Yes.
75,000 the actual depreciation, right?
Right.
So we here we are passing the entry with the net amount, not the gross amount, right?
True. Yes.
So rather than this, we can pass is the gross amount. So that is the my confusion here. We can pass
Okay.
like 75,000 and 50,000 is the credit, and net off is the 60,000.
Yeah, so the reason I'm trying to show it differently, kind of in a two-step fashion, because
Okay.
in the book you need to have two separate depreciation streams, right? Because if we show the depreciation at overall 300, that will be even confusing, because in a way we are saying that okay, organization owns entire 300,000, right? But when it comes to depreciation, basically we need to show that the reduction in the value on the P&L is 75,000, no matter who owns that. Is this right or not? Because suppose in this case, government owns how much? 60,000, the grant that the government has given. Government has really given the grant for 60,000. But the entire depreciation should happen at the 300,000 level. But here we are trying to just split the two amount of depreciation separately. I think even if we just bypass this entry, it will still do, because where you are landing at the end, it is the same number. It is 75,000 of the total depreciation that we're charging, right?
Yes.
So we are just saying that okay, so this 75 is coming from 60,000 and then 15,000. Here also, statement of financial position. Look at the total depreciation. Right. So there is no difference between the two numbers. So we are saying essentially that 240,000 is depreciated by 60K. Remaining 60K is depreciated at 15K. This is 75K. If we want to have, we can club the journal entry, depreciation of 75K, and create the asset by 75K, or we can have two parts, 60K and 15K.
Yeah.
The only difference is that 16K that needs to reflect separately in the books, so that we can see that how much organizations own asset are depreciated. But then 15K should be added, because this is another depreciation which is happening on the government grant. So net impact is the same. A non-current asset depreciated at the rate of 75K. Then it is appearing the same 75K here in the P&L. And if you look back, I think here it is even simpler. So 1 second, right? So we had EBITDA of 100K, 75K is depreciation. Your EBIT is, or say net profit is 25K. Then you add the grant, which is 15K. So this one is 40K. Okay.
Yeah.
So remember this number. So this is what we have achieved here, right?
Right.
So it's just tying back, but 75 should be seen in two parts, 60 plus 15. Just so that from the disclosure perspective, we reflect what is the government part, what is the organization's own part of depreciation. But the total will be same. And that journal entry can even go into the table of the disclosures. Statement of financial position. Any question on this? So 300,000 we started with, and every year we are reducing back to zero. In terms of liability, so the deferred income that we popularly call it, this deferred income is our liability, which is going down year on year. 45K, this is at the end of the year. So 60 was at the start, end of year 45, 30, 15, and then zero out. So now do you see that how all the three primary statements are tying to each other. What is on the previous page here? Okay, reducing the cost of asset. So profit before depreciation. So this is another way of showing the P&L. So if you don't reflect, okay, let's go one step back. So this 75,000 and 40,000 of income that we have shown, that is on the basis of if you recognize the deferred income, right? If you recognize the deferred income that the government has given you the grant of 60K, then this method is applicable, okay? Because then we have a second method also to apply. What happens if we don't recognize the government grant directly and we just say that the worth of the entire machinery was only 240,000. Okay, you remember there was a second method for the direct reduction of the carrying value.
Yeah.
Yeah.
If that happens, reduce the cost of asset directly. So if that happens, then your profit, you remember, was 100,000 earlier. And if you take the approach of reducing the cost of the asset, if you reduce the cost of the asset, in that case only and only, your profit still remain the same.
Yeah.
100K minus 60K, because then your depreciation is limited to 60K only. Similarly, your financial position, FP, is also starting at 240K. I think I just need to move this one. Yeah. So this is starting at 240K. And at the end of the year, it is 180. And a simple straight line depreciation is used. So the question could be that which one is better for overall balance sheet and the P&L? Which accounting method should be used? Or if you are given the choice, which one would you prefer? And why?
No, definitely we can choose the income approach.
No, I think the first method where we are showing the complete disclosure, I think, Nidhish, because if shareholder or something, we are showing 100% disclosure, like we are having the assets of this prices and we are getting a grant of this one, and we are doing a proper accounting entry. Yeah.
True, I agree to that. But my question is this time a little different. If you are given a choice to choose between the two, and both are equally reasonable from auditor's perspective and disclosure perspective, right? Which one would you prefer as a finance director? Because you remember, you need to also show that your company looks good, or at least you need to, show the strong financial statement without doing anything illegal. If you are given a choice that you can use either, which one would you prefer to use?
The second one, then, after reduction, because I don't need to maintain any complexity in the accounting entry and all this thing. It should be clean and
right. The additional reason could be that if you choose the second one, you don't have to create extra asset. Your asset, remember, in the first case is 300,000 when you have deferred income, and your liability is 60,000. Your current asset is current ratio is lower. When you create more liability, your current ratio is worse than when you don't have the current liability. So when you have a liability in your books and records, then your financial ratios are worse off. So from those perspective, and also your ROI, your ROA, everything will be worse off if you have the first approach, because your asset is just inflated, your liability is also inflated or maybe higher as compared to the second approach. So many people would prefer having the second approach. We have one more question. You can look into that later. It is more theoretical. We can move on to the next standard.
Yeah. Yeah.
Yeah.